core to being an analyst at Capital is the ability to commit capital, being able to invest, even if you like a company and you can't get any partnership from portfolio managers, and you say, I'm still going to invest in this company and put it in our research portfolio. That is what I think part of the secret sauce at Capital is. At most of our competitors, analysts can't commit capital.
So would you call yourself an unemotional investor?
I'm more comfortable with uncertainty than many analysts. I kind of know you're never going to know everything. And this notion of false precision is one of those things that I think freezes a bunch of analysts.
As an analyst, and again, a retail analyst, you first focused on small cap. So why?
It really resonated with me to look at smaller companies. And the reason is...
Today we have Greg Wendt joining us. Greg has been at Capital Group for 37 years, based in San Francisco as an equity portfolio manager. Greg, welcome. So Greg, this is going to be what I like to refer to as the wisdom podcast. No pressure, but you are going to share your wisdom because you are on the doorstep of retirement after 37 years at Capital. So first of all, congratulations and thank you. And second of all, we are very excited you joined us to help share some of your 37 years with everyone who's watching and listening. So we're going to start way, way back. And pre-MBA, you were a manager or a buyer at a department store. And there's no better place to start than the mall. And I'm going to get into, this is not officially the treasure hunt, but I'm going to show you something. And we have it on our screen for people watching, and I'll describe it and ask you to share something about it for those who are listening. It's a carnation, a little old yellow carnation, and it says, I care about you. Hecht, which is the department store, with Greg Wendt's name on it. So tell us a little bit about that start and how you went from Hecht's department store as, my name is Greg, I care about you, to Sam Walton's office and Walmart in just a few years.
Mike, first of all, thanks very much for having me on. Great to be with you. After I graduated college, I interviewed with a bunch of companies. I ended up joining a company called May Department Stores. May had divisions across the country. I was department manager at Hecht's Montgomery Mall, which was in suburban Maryland. I applied and got into Harvard Business School. And so they were very excited that a department manager was going to do that. They brought me back to corporate, and I worked for one of the vice chairmen. And so my favorite thing about that experience was at a pretty young age, 21 to 23, I saw a company from the lowest level to the highest level. And I found it fascinating. I ascertained pretty quickly after getting to corporate that there was no alignment between the layers of management, and it was not a particularly collaborative culture. Mm-hmm. As an analyst later through the years, I kind of always put May Department Store in the box of companies that probably would get acquired, and it did. It was never going to be the leader. That ended up being Macy's, but it was a fascinating top to bottom experience. Coming out of business school, after I joined Capital, I was our retailing analyst. And based on what I saw at May, my view of the world was that retailers were merchant-driven, visionary-driven. And I used my time to write my industry review, which, as you know, is our rite of passage as an analyst. I used my time to spend as much time as possible with folks who had built great retailers. Top of that list was Sam Walton.
Sure.
And I was able to get some time with Sam. And Sam, who was kind enough to take me on some store visits. I was trying to remember when we did the Walmart cheer at a couple of the stores, whether or not he was the squiggle in the middle or I was with the squiggle.
One of you was squiggling.
Yeah. Walmart, the logo has changed, but it used to have a squiggle in the middle. And it was just great to spend time with him. He had great, clear understanding of what the company should be. He allowed me to join him for some internal meetings. And it was just a wonderful way to learn the business. I will tell you, in our business and given who we work for, we get to meet a lot of the living legends. He's the rare living legend that exceeded every expectation.
And so how old were you when you met him the first time?
I was probably 24.
And so you got an audience with Sam Walton when you were 24 years old. Had he met folks from Capital Group before?
I think it's accurate to say this. I was the first capital analyst to recommend Walmart. If you were willing to go to Bentonville and you worked for a firm that his CFO respected, and he respected capital, you would get time with Sam. I think Sam liked me even more than the typical analyst, because I'd been a department manager a couple years before.
You'd seen it.
Yeah, and Sam, for example, when he walked through a store, would ask a department manager, "What's your VPI, your volume producing item, the thing that they were trying to move?" And I could relate to that, and so I think Sam was like that.
You spoke the lingo,
and so obviously Sam is gone, but his office has been moved to the Walmart Museum. It's in Bentonville. It's totally worth a trip. And when I took my kids there, and that was the office I used to meet Sam in.
So let's go to Harvard Business School. You found Capital Group while you were there. How'd you find us, or how'd we find you?
Fate, luck, whatever you want to call it.
Both.
For reasons that I'd really find hard to defend, I decided my job search would be focused on fixed income trading and venture capital. And I signed up for every venture capital interview I could. And Capital Group's sign-up sheet, in those days, pre-internet, it was notebooks, sign-up notebooks, was in the wrong book. It was in venture capital. And so that's how I ended up interviewing with exactly one investment management firm.
The non-venture group in the venture booklet.
Yeah. And as I went through that process, I received an offer. And as I've often said, it's the rare time I did the right thing for the right reason. It was a bull market. Salaries were high. Capital was my lowest paying offer. And I took it. And the reason I took it, and in those days, seemed like a lot of money I was leaving on the table. I took it for the right reason. I took it because the people I'd met at Capital were the most curious, interesting, good fit people I'd met. They just resonated with me. It's who I wanted to work with. And so,
and was that right after the stock market crash?
No.
When was that?
Market crashed in '87.
Yeah, so when was
I
that?
joined in August, and I got to watch.
Oh, so you got just before, you did here just beforehand.
Yeah.
Got it.
And watching that is still a vivid memory.
So you join in August, the market crashes a couple months later. October. So how are you? You're in the middle of your industry review, I'm guessing.
Yep.
Does that change how you conduct your industry review when you see the stock market drop 20% in a day? I mean, did that impact your long-term view? Or it's probably hard not to when you just see something that dramatic, but how did it impact your industry review lifetime?
Really what struck me, it didn't affect the way I looked at retailing and what I presented in my industry review in April. But what really struck me was how calm and professional we were during that.
It wasn't a crisis mode.
Right? And one of our portfolio managers who'd had a lot of cash was trying to put it to work as quickly as he could. And, it's what he'd been waiting for, and he had the discipline to pull the trigger. It was fascinating to watch. Again, I'm not sure I knew what was going on. I will say this, John Lovelace met with groups of us in 10 after that and, said, we are a very strong company. Everything's fine. We will get through this. No one should worry about their job. And until he said that, I didn't worry about my job. But
that's a good lesson. I got to keep that in mind.
But it was great. It was a formative experience. And, Bob Kirby, who was one of our colleagues, ended up being on the Brady Commission that looked at the crash, appointed by the president. And so, you kind of saw the full story unfold over the next year or two as the Brady Commission reported, and Bob told us about what they were looking at.
So we're going to get into you as a retail analyst and small caps and all that. Before we do that, I do want to go through the office treasure hunt from your San Francisco office quickly. Fisher Price products at a Toys R Us store. So we have a picture for those who are listening, just so you're aware, we have a picture of a very young Greg Wendt at a Toys R Us store. Maybe describe it for folks who are listening. The viewers can see it, but describe it.
I'm in the infant and preschool aisle of a Toys R Us with the CFO of Toys R Us, and we're talking about something. That picture I keep more to remind me about Fisher Price than Toys R Us. And Fisher Price was one of those stocks where everything went right. It had been owned by Quaker Oats, undermanaged by Quaker Oats. Quaker Oats decided to spin it off. And the spin-off rules are that if you spin off, you can't be acquired for a certain amount of time. But very seldom have I seen a company so obviously being set up for acquisition. And I think this is accurate. I think literally it got acquired the first month it was able to be acquired for accounting purposes. And it, so it was a company I got to know pretty well. Knew it both as a division of Quaker, but also as an independent company. And it was truly one of the examples of, if you kind of know the details, that matters. And if you just kind of know what the investment thesis is and stick with it, kind of ups and downs, the quarters don't matter. Fisher Price belonged in a bigger company, and that's what happened.
Got it. As an analyst, and again, a retail analyst, you first focused on small cap. So why? I mean, at Capital Group, you can choose what you focus on within reason and within your sector. How'd you choose small cap? And it ultimately led to the launch of a small cap strategy. But talk to us about the beginning and then the work up towards the strategy launch.
I focused on smaller companies because it was just more fun. You had more access to management. I think you had a bigger competitive edge, even in those days. And so as I did my industry review and identified interesting companies, a lot of them that had never been talked about at Capital, they all ended up being small companies. My first recommendation was a Dillard's department store. Second recommendation was Carson Prairie Scott, which is no longer around. It was acquired. It was number 2 in Chicago. My third recommendation was Egghead Discount Software. So they didn't all work. Egghead was a disaster. I got stuck with the nickname Greghead for a while. But it really resonated with me to look at smaller companies, easier to understand. The alternative in my mind was trying to figure out what Sears was doing, and I'm not sure Sears knew what it was doing. And so after my first series of recommendations, both good and bad, being all small cap, one of our colleagues, Gordy Crawford, grabbed me and said, "You're the guy I've been waiting for. You and I need to get us to launch a small cap fund." And Gordy and I lobbied and lobbied and lobbied. And for a bunch of different reasons, it got greenlit in 1989. We finally had a home for some of these ideas, launched it in 1990. And at the time, it was the second largest mutual fund underwriting of all time.
Wow. And for you, that you were able to make a difference because there weren't 150 analysts going into these companies every day. They were untouched and unloved by folks. So
there was one company I went into where I walk in and the receptionist said, "Hello, Mr. Wendt." I went, "How'd you know it was me?" They said, "We don't get a lot of people in coat and ties."
That was it.
Yeah.
If there was someone at a tie coming in, it was you.
Yeah. And so, I mean, that's just an enormous amount of fun. It's also, you're in much more unknown, risky territory, and you got to have an appetite for it.
So joining a couple months before the stock market crashes, going into retail, looking at small caps, launching a small cap strategy, and then fast forward, you're here 37 years. At some point, you figured out you're going to be here for your entire career. And again, as you're on the cusp of retirement very, very soon, think back. When was that? When did you know you were going to be a Capital Group for your whole career?
Oh, I know the exact day. It was in 1992. Small cap was up and running. My contributions to the portfolio had not been particularly successful. That was hard for a new analyst, particularly one with as much psychic investment in the fund as I had. And Bill Grimsley, very senior guy in the firm who was on management committee, came in and he said, Greg, I've got some cash I'd like to put to work. What 5 stocks should I buy? And I went, Bill, thanks for asking, but I've done nothing but hurt people. Why would you ask me? He said, I've been watching the way you think. I like it. And frankly, I think you're due for some up stocks. And we picked 5 stocks. He bought them all. I think 4 out of 5 worked. But I thought to myself, Bill, who'd been in the business probably as long as I have now, didn't need to come into my office and do that. He threw me a lifeline. And
he believed in you.
Yeah. And, it's not just Bill, but that's the culture. And I kind of decided I'm going to spend the rest of my career here because these are the people I want to work with.
Well, that conversation was 33 years ago. So it clearly worked. And I'm sure you've done the same with others. And we'll get into that in terms of mentoring. Texas Roadhouse. I know it was an important investment, important stock for you. We talked about it a little bit, but can you share with others why?
Texas Roadhouse is a great example of if you produce the lowest price product in the industry, but it's also the best product, things ought to work well for you, and they did. So Texas Roadhouse, just a great growth company. But the seminal discussion for me was the first time I went to meet with the CEO, Kent Taylor. And we were having a good conversation about the business and the industry. And I made the mistake of mentioning one of his competitors. I won't say who, but he said, I don't even want you to say that name in my office. Do you know what they do to their lettuce? And I went, no. And he said, they store lettuce in sort of 3-foot tubs. And by the time you get to the bottom of the tub, you're serving people terrible crushed lettuce. Our tubs are 6 inches deep, so the lettuce doesn't get crushed. And I went and just thought about it. I went, the financials, I understand the company. It was a fairly high multiple, but I really wanted to invest with a guy who cared that much about his lettuce. I will also say this about Kent, who has since passed. His book about building Texas Roadhouse and about being an entrepreneur called Made from Scratch is one of the great business books I've ever read. And I'm not just saying that because he gives me a shout out in it. It's just a great book.
All right. I'll pick that up. That's interesting. And it was probably one of those early lessons in investing of the details matter.
Yeah. And passion matters.
And passion. And speaking of passion, as an analyst, you were passionate. You took on a diversified portfolio manager responsibility. You came back and were an analyst. Share with folks the journey, because I think one of the things that makes us pretty darn unique is whether you're an analyst or a portfolio manager, you're an investment professional. Other firms, if you're an analyst, you may be a stock rater, you may be a credit rater, you may tell people what to do, go buy this, go sell this, go hold this. But at Capital Group, you're investing real money on behalf of our clients when you're an analyst. So talk a little bit about the journey, analyst, PM, your thoughts on the different roles and how you navigated that journey.
Core to being an analyst at Capital is the ability to commit capital. Being able to invest, even if you like a company and you can't get any partnership from portfolio managers, and you say, I'm still going to invest in this company and put it in our research portfolio. That is what I think part of the secret sauce at Capital is. And so as an analyst growing up at Capital, I always accepted that's the way it was. But then you find out at most of our competitors, analysts can't commit capital. And what analysts are trying to do is get promoted to portfolio manager. And so I was recently told, as I'm on this retirement pathway, that in terms of managing money as an analyst, I've got the longest track record in the history of capital. And I'm delighted by that. I added the most value for our shareholders by doing that. And frankly, I had more fun. I think analyst is the best job in the world. And I will say this, there are portfolio managers who are really good portfolio managers who think they have the best job in the world. And that's how it should be.
Yeah, the lack of judgment and the lack of comp delta or differential, and just being able to say who's adding value to clients' portfolios. And there's part of the secret sauce. And there are a lot of companies that talk about, well, we have career analysts. And then you look to see, and they don't really have career analysts. Being able to be a career analyst, invest real client assets, have an impact in our portfolio is something you did. And it's something special for us. You also wrote something recently, and folks tend to write a lot more when they're close to retirement. You wrote something about 5 investing mistakes that people make. And so what are some of those investing mistakes that people make?
Well, the one that I talked most about in that piece, and it's a mistake I repeated. We all make mistakes. The goal in this business is not to repeat them, but I repeated them, is story stocks. Stocks that almost sound too good to be true. And one of the examples I talked about in that piece, and I'm talking about it because I'm still frustrated by it. It should have worked, right? But I'll tell you what I missed in a second. There was a company called American Classic Voyages. Sam Zell had taken control of this one cruise ship that had this unique ability because of the Jones Act and the history of the cruise ship to cruise the Hawaiian Islands. Normally, if you cruise the Hawaiian Islands, you go around the Hawaiian Islands, then you run off to another country and come back. He could just keep on cruising around the Hawaiian Islands. So American Classic Voyages was kind of this shell company that had this asset of this right. He raised a bunch of money, and he was going to build the new cruise ship that he could transfer the right to. And it had to be manufactured in the United States, the cruise ship. Well, it turns out the United States shipbuilding industry hasn't done a cruise ship in 50 years. And while I did all the work I needed to do on understanding the financials and understanding the regulatory environment, I didn't go and spend enough time at the shipyards to understand we don't know how to build cruise ships in this country. And they failed. They ended up towing the hull to Italy. It was finished over there, and American Classic Voyages became a zero.
Yeah, it's an interesting story. It's part of the whole process. We had Lara Polini on one of our podcasts, portfolio manager based in London, and she talked about, as an analyst, wanting to stock the shelves at Tesco, and at a food delivery place, wanting to ride one of the motorcycles and delivering the food, and being a fishmonger, and doing some of those things along the way to see what was really happening. Back to your department store, what was really happening at that department store, not what you read in someone else's report, but living it. And the closer you get to that, the more success you tend to have.
Yeah, I remember a day I spent on a direct store delivery truck with dryers as they went around and stocked freezers and tried to steal 1/4 of an inch from the competitor in every store. It was just fascinating. It's hand-to-hand combat out there, but you really begin to understand how gains are made.
So you've talked about mistakes made, and all of our folks are self-deprecating and talk about the mistakes being a lot, having a lot of them. But you also had an investment edge, and you said you're a better analyst than portfolio manager. As an analyst, what do you think your investment edge was over others? What made you different? What generated that track record?
It's an odd thing to say, but I think I'm more comfortable with uncertainty than many analysts. I kind of know you're never going to know everything. And this notion of false precision is one of those things that I think freezes a bunch of analysts. Bob Kirby, one of our colleagues, used to say, if an analyst can get the earnings trajectory of a company right 3 years in a row, not the point earning estimate, not will they earn 321 or 323, are earnings going up or down? And if you can get that right, you've done over half the job. And so I think I'm very good at understanding what I need to know, getting to that point, and making a decision.
So would you call yourself an unemotional investor?
I got there. I wasn't originally.
That was a journey.
Um, um, I forget what year it was when Yeltsin and Russia and there were tanks outside the government buildings in Russia, and the market got clobbered. And that was the first time I bought stocks without emotion, where I saw what was going on in Russia, and I went, it's not going to affect the earnings of these 4 companies, and these stocks are down 20%. We got to go buy them. And it took a while to become dispassionate.
And it must be a hard thing to teach new analysts is not to be emotional, because you're tied up into it. You've done the research, you've met the management, you own it yourself in your research portfolio. You've recommended it to portfolio managers. You're emotionally invested, and you're invested with client capital. So trying to teach folks, how have you done that? How have you taught folks? Is it just by storytelling yourself about the mistakes you've made? How do you teach others not to be emotional and to use those periods for opportunity and not for fear?
Well, you just have to be self-aware. It's not that you have to stop caring about these companies and stocks and relationships. You just have to understand that detachment is necessary. And you have to be able to look back almost every day. It's a daily discipline of where are prices, where's the market, where are fundamentals, what makes sense to do here. And that, again, I've got great friends I've made on the company side, on companies we've invested with through 38 years and almost 38 years. And they don't take it personally when you sell their stock. I mean, they know we're in the business of doing the best thing for our shareholders.
Period.
That's it.
Yeah. Best piece of advice for a new analyst.
There's a lot of travel in this business, but you should travel even more, because that's where you learn stuff.
Kick the tires.
Yeah, and it's being out there with companies, with competitors, trade shows. That is where you see things that really give you insight. And so I just get on the airplane.
So in this world of democratization of information, it's still important to go to the company, go where they are, go where their customers are, talk to everybody, do all that in the field, and don't just assume that the Zoom call has satisfied all your questions.
I'll go one step further. And I know what I sound like an old guy. I've never built a relationship on Zoom.
Yep. It's a good lesson for folks to be out there and do that. Your wife, Lisa, is here in the room with our lawyers listening to make sure none of us say something wrong. But she's here with us today, and our production team in the back behind this fancy screen. You have 2 kids finishing freshman and junior year of college?
Yep.
Talk about them on this journey with you through your Capital Group journey.
It's bring your wife to work day. My wife had been in the business at one of our competitors when I met her. So she's always understood what I've done for a living and has been incredibly supportive. I think the thing that I want my kids to take away from my career capital, and I think it's what they do take away, is I have loved my job. It's just a special place to work, and it's a wonderful industry. And I think my kids seeing me go to work excited every single day is one of those things you hope they get to do. And so any parent knows you can't pick a kid's job for them, or I just hope that they find something that is as satisfying as my career has been at Capital. And if anything, I'd like to believe I help be a role model to understand that that's an important objective.
Do something you're passionate about, which you've been passionate about this for sure. Last thing before we get into the moment of gratitude, which is a great way to end these discussions. You have any hidden talents? Because we got Andrew Sussman to do a headstand. Like, do you have any hidden talents, Greg? Wow. Well, that's not hidden any longer, my friend. That is front and center, and that is out there.
That got me through grade school and every show and tell for years.
Wow. We got to ask everyone for hidden talents. You don't know what's going to come. Let's finish with a moment of gratitude. You, personal, professional, this is a judgment-free zone, Greg, as you know. I'm going to give you this large mug that talks about being obsessively grateful and ask you to share what you are grateful for.
There are so many things, and it's a long list, and I've watched a number of our colleagues do these discussions. And so you think about it, and, at the end of the day, I'm so grateful to have grown up with parents that helped me find my way. My mom was a highly opinionated woman who shared her opinions freely. My dad was a pretty quiet guy who didn't share many opinions. They were different in many ways, but a great team. All 4 kids were set up pretty well in life by having engaged, caring parents who gave us the room to do what we wanted to do. So there's a long list of things I'm grateful for, but my mom and dad were 2 of the most important influences in my life.
That's great. Well, on behalf of the 9,400 associates at Capital Group and the millions and millions of clients around the world, we're grateful for your 37 plus years at Capital Group. It's, we're fortunate that folks like you want to come and stay for the entirety of their careers, want to have an impact on people's lives through what they do, are passionate about what they do, and you've made a difference. I'm glad you've shared your words of wisdom with folks. It's important to pass that along to others so they can benefit from them. But thanks for caring about your job every day and making a difference for our clients.
Mike, it's been a privilege to be part of this team for almost 38 years, and thanks for having me on today.